All right, welcome everyone. You know, we've all seen the headlines about these companies that look amazing on paper. They're Wall Street darlings, profits are through the roof, and then seemingly overnight, they just collapse. So what's the deal? Well, so often, the real villain isn't a lack of profit, it's a lack of cash. You can have these beautiful, rosy reports, but the bank account is completely empty. And this, right here, is where the cash flow statement becomes one of the most important documents in business. We've talked about financial statements being the language of business. Well, think of this as one of its most critical, most honest dialects. Because this isn't about profitability, it's about survival. It's about cash, literally the lifeblood of any organization.
So here's our roadmap for today. We're going to dive deep into cash flow analysis. First, we'll start with what I call a tale of two methods, the two fundamental ways a company can tell its cash story. Then we're going to really dissect each one, the direct method and the indirect method. We'll look under the hood and see what makes them tick and what they're each good for. After that, and this is key, we're going to bring it all into the real world. We'll talk about when you'd use one versus the other and why. I want you to see this isn't just some accounting exercise, This is about mastering the art of financial storytelling and strategic control.
Okay, let's jump right in. Picture this, a hot tech startup. They've got a product that's changing the game, and their income statement, it's showing these incredible profits from huge sales contracts. But behind the scenes, they're sweating. They're struggling to make payroll. They can't pay their suppliers on time. So how is that even possible? Well, it's simple. They made a ton of sales on credit, but the actual cash hasn't hit their bank account yet. This is the exact paradox the cash flow statement is designed to solve. It just cuts through all the accounting noise, all the accruals, to tell you the real unvarnished story of a company's cash. Where did it come from and where did it go? And believe it or not, there are two really fascinating ways to tell that story.
So think of this as two different paths leading to the exact same place. First, you've got the direct method. This is like a super detailed cash diary, It tracks every single dollar that comes in and every single dollar that goes out. It's the financial version of a 4K high-resolution photo. And then you've got the indirect method. And this is the one you're going to see pretty much everywhere. I mean, go pull up any public company's annual report, and this is what you'll find. This method is more like a detective story. It starts with the profit number everyone knows, and then it works backward, finding all the clues, things like non-cash expenses and working capital changes, to figure out what the actual cash balance is. Now here's the kicker. They both give you the exact same final number for net cash from operations, but the journey they take to get there, well, that tells a completely different tale.
Okay, so let's get to know our first character in this story, the direct method. Now, this one is the no-nonsense, straight shooter. It doesn't mess around. This is the perfect tool for that hands-on manager who absolutely needs to know right now what's happening with their cash. It is, without a doubt, the peak of financial transparency. It gives you this crystal clear, almost day-to-day view of the company's financial pulse.
What's so interesting here is the fundamental trade-off, right? On the one hand, the clarity is just a dream come true for an operations manager. I mean, you get a line-by-line breakdown. Here's the cash we got from customers. Here's the cash we paid our suppliers. Here's what we paid in salaries. It's like having a perfect itemized receipt for your entire business. And for short-term cash forecasting, that is absolutely invaluable. But, and it's a big but, all of that beautiful clarity comes at a pretty steep price. Just imagine trying to track and categorize every single transaction you make for a month. Now scale that up to a huge multinational corporation. It's a massive, massive data collection headache. And that's exactly why, even though the official standard setters actually prefer this method for its clarity, most companies just don't use it. They take the easier path. All right, so now let's turn our attention to the other method, the indirect method. And here's the key difference. If the direct method tells you what happened with your cash, the indirect method tells you why your cash is different from your profit. You can think of it like an executive summary. It's the thing that connects the dots between that profit number you see on the income statement and the actual real cash you have in the bank. It's the bridge that connects the world of accrual accounting with the cold, hard reality of cash. The real magic of the indirect method is how it translates accounting speak into plain cash speak. So here's how it works. You start with net income, right? Now think about an expense like depreciation. You record it as an expense, so it lowers your profit. But did any cash actually leave the building? No, of course not. So the indirect method very cleverly adds that non-cash expense back. It does the same for things like accounts receivable. If your receivables went up, it means you booked a bunch of sales that you haven't collected the cash for yet. So the method subtracts that increase to get you closer to the real cash number. And this whole reconciliation process is precisely why investors and analysts absolutely love it. It helps them figure out the quality of a company's earnings and see if those reported profits are for real or if they're just some kind of accounting mirage. And this brings us to a really crucial point. This is where a lot of students make a mistake. They start to think that one method is just, better than the other. But that's not it at all. Choosing between the direct and indirect method is really like choosing the right tool from a toolbox. You wouldn't use a hammer to saw a piece of wood, right? It's not about which tool is superior. It's about which one is right for the specific job you have to do. And the key question you always have to ask is, who am I preparing this report for? And what decision do I need them to make with this information?
This table here just lays it out perfectly. So let's do a little role playing. For a minute, I want you to be a division manager. Your bonus, maybe your whole career at this company, depends on keeping your operations running without a hitch. You absolutely have to know if you'll have enough cash to pay your key supplier next Tuesday, because if you don't, your whole assembly line could shut down. For you, the direct method is your best friend. It gives you that real-time, actionable data you need to survive. Okay, now switch hats. You're a sharp investor. You're looking at a company's annual report and you're trying to decide if this is a solid long-term investment. The indirect method is your go-to. It lets you take that big public net income number and dig in to see just how well the company is converting its profits into cold, hard cash.
So here's a little thought experiment for you. I want you to put yourself in the CFO's chair at a fast-growing company. In the morning, you have a meeting with your department heads, the people on the front lines, deep in the weeds, worrying about supply chain issues and making payroll. What kind of cash flow report are you going to bring to that meeting to help them manage the day-to-day? Okay, now later that afternoon, you have to go present to your board of directors. They're thinking about a huge strategic acquisition. What story about the company's financial health do you need to tell them? Your ability to tailor the financial story to these completely different audiences, well, that's what separates a decent CFO from a truly great one.
So this is really the heart of it all. Creating a cash flow statement is not just about checking a box for the auditors or satisfying some accounting rule. No, it's a powerful strategic storytelling tool. It's like being a film director and choosing exactly which camera angle, which lens, and which lighting to use to tell your story most effectively. And the choice you make, especially for your own internal team, is going to shape how everyone in the organization sees the company and its challenges. Let's really break that down. The direct method, that tells the story from the perspective of the trenches. It's about the day-to-day battle for cash. The cash coming in from customers, the cash going out to vendors. It's gritty, it's immediate. But the indirect method, that gives you the view from the command center. It's the strategic overview of how your entire business model, how your financial management actually turns a profit into real cash. As a future leader, you absolutely have to be fluent in both of these languages. You need the ability to zoom way in on the operational details and then zoom right back out to see that big strategic picture. So what's the bottom line here? If you remember one thing from today, let it be this. Accounting is not about counting beans. It's about making sense of the business. The real power of these financial statements isn't just that they're accurate, but that they are useful, that they can inform and inspire people to make better decisions. By really mastering cash flow analysis, you're not just picking up another technical skill. No, you're developing the financial intelligence you'll need to lead with real confidence and clarity. So I encourage you, go out there, grab an annual report of a company you find interesting, and start digging in. Start asking the right questions.